The ICT bearish rejection block. All right, so yesterday I gave you the framework for this being a market maker sell model. And I mentioned during the recording, the first half of the recording yesterday, I mentioned how there was a potential order block in here and we wanted to see that fail. In other words, a bullish order block in yesterday's video. If it goes down too deep in that, that's a confirmation that we have, in fact, worked off of this rejection block. Okay, so this was yesterday's framework, is what I was looking at, that I did not include because I wanted to have a teaching today on this very topic, rejection blocks. Now, when the market had ran up into this level here, you, if you're new, look at that as relative equal highs. The framework for all of that was this rejection block right there. Okay, so we traded up into that level and went down into this level here. And some of you may have looked at this imbalance and said, okay, it's rebalancing there, and now it's going to run the relative equal highs. That is not necessary if you're looking at time of day and the economic calendar. So at 8:30 yesterday, when we had PPI number for the US, we had a high impact number, and we had already ran out rejection block there, and we dug in. Then I incorporated what? The bullish order block failing. I didn't want to buy it. I wanted to see it fail. And when that failure in the order block happened, that confirmed to me that we had the rejection block turning the market here. And this, in fact, was a market maker sell model that I wanted to be in this particular order flow and not try to expect it to go higher. And it gets in sync with what? What we were looking for higher dollar. Once you have a higher time frame rejection block here, once you have that, you got to go down to a lower time frame. And this chart here, we can drop down into a 5-minute chart and then see all the things that you watched me do yesterday with calling the outline move and how it delivered. So a higher time frame rejection block, then use the narrative and bias to get in sync with a setup. Or in other words, a rejection block on a higher time frame is a catalyst. It's not a timing tool. It's just, okay, we have ran a rejection block, now drop down to a lower time frame. For instance, if this is an hourly chart, once we have the rejection block and then we're standing in front of a news driver like we had yesterday at 8:30 in the morning, the dollar PPI number, I wanted to see it prove to me, let the algorithm speak through the chart like I'm teaching you to interpret it. Not that it's doing so much of that all the time, but the way I teach you price action, that's what I'm trying to convey to you. These languages that I teach with PD arrays, with bias, will give you the tapestry to work within price action to see setups forming, when to engage, what to anticipate, why should it be doing this at what time, and then how should it deliver? Should it deliver, lethargically, or should it run aggressively? Second stage distribution, that's when speed and magnitude comes in, and this is what you get. It ran right down into the sell side here and continued over into a secondary run. Conversely, for the ICT bullish rejection block, we have a low, the lowest down close here, and we trade down to that. At that very moment, okay, at that moment, as soon as we sweep below that, again, assuming this is an hourly chart, as soon as you get the rejection block and it moves away from that, and say the bias is calling for this to go higher, whatever market this would be, okay, if it's calling for it to be higher and you have a rejection block, and this is hourly, you drop down to a lower time frame. It could be a 15-minute time frame, it could be a 5-minute chart, okay, but you're going to be looking for something after this low forms. That would be a bullish discount array. And what does that look like? Well, here's a 5-minute chart after it sweeps the rejection block. It doesn't take out the old low. This is the rejection block. It trades down into that, and then what does it do? It runs up, breaks market structure. Now it's bullish on the lower time frame after a higher time frame rejection block. What does it leave here? Buy side imbalance, sell side inefficiency. Order block. Trades down to that, rallies, comes back in again, order block, rallies once more, order block, supports it here. So now down close candles are doing what with price? Supporting it. You have multiple entry points in here to get in sync after the rejection block. Okay, so rejection blocks can be traded right into them if you're really strong with your analysis. In other words, you know that we're running out liquidity. It's not going to take out an old low because this market might be diverging when another SMT related correlation is saying that it went lower on this run here. This one's failing to go down. Well, wouldn't that be SMT? Right. So this is the pair or market you would use that you anticipate not seeing the low taken out because it's diverging bullishly when a correlated market would be going lower. How do you trust when to get in the marketplace and it's not going to take out the low? SMT. So there's a time and place for everything, but you have to have experience looking at it, studying it with that context. And once you have that, you can trade that rejection block right into it and buy it. But while you're learning to trust it and use it, you can wait for it to react down there. And then once it creates that run higher, then go in, start looking for your discount or raise. And then there you go. And then the down close candles confirm order flow is bullish. Every down close candle is support and price. This one here has that little tail, lines up right there, and it rallies. This down close candle here, it drops down into that, and it rallies. Okay, order flow is bullish. So you can take trades on this 5-minute chart framed on the hourly chart rejection block that's bullish. Okay, main takeaways again are: how do you know when the low is not going to take out the low that was made prior to it and just hit the rejection block? You want to be measuring it against a correlated market for SMT purposes. So preferably the correlated market, say for instance that this is, say, and it's not, but let's say this is euro. Okay, and as euro was making this low here, now on the 5-minute chart it shows a lower low, but remember, before I did this, this was the chart here on the higher time frame. Okay, so let's assume this is an hourly euro. It's not the euro, but let's just say it is. This low and then the higher low that's forming here, at the same time, dollar index may be making a higher high when the euro is making a higher low. That's diverging. Okay, in other words, the euro should have went lower than this low when the dollar itself makes, at this same time in the chart for euro here, it should be forming a higher high in dollar. That's SMT. So your smart money technique of looking for divergence between correlated pairs or inversely correlated pair versus dollar, euro is going to be the opposite of dollar. So if euro is making a failed lower low, it doesn't go lower than this, in a symmetrical market, dollar should be making a failed higher high. But if the dollar is making a higher high right here, when the euro isn't, then you look at the rejection block. That's your catalyst. That would be the entry for me for a rejection block. I would be trading it right when it gets into that price right there. I'd hit it right there and trust the fact that we won't take out that low because it's showing divergence in the SMT between the dollar. Okay, or this could be the euro and say the pound is going lower here and then pound went lower than its low here, respectively, in terms of time, where euro isn't. That means for a correlated pair SMT divergence, euro is relatively stronger. I can buy the rejection block, which is that lowest down close price. Buy it right there. And then go into the 5-minute chart, wait for this move here, pyramid, buy more of it here, wait for the run here, go in here, buy more, pyramid, buy 10 lots here, buy 8 lots here, buy on this in here, 4 lots, and in here, 2 more lots, and then let it run. And that's how I would pyramid. That's how I would build in a position, the largest being the initial, because that supports all the subordinate smaller ones. And it's not an inverted pyramid, which is not stable. The pyramid with the widest base at the bottom is how you properly pyramid. This way, if you have your largest position down here, and you break the high, you have market structure in favor for higher prices. And then you watch how all the bullish order blocks provide support, and you know order flow is bullish. And you can build in a position and pyramid that up. Each PD array could give you this same framework. What constitutes this market going higher here? The rejection block and the logic that may be SMT divergence framed with this pair or market expected to not make a lower low. So So it's going to go higher. Wait until it breaks market structure. It does there. And then what happens? Wait for it to come back down to an order block and fill in the imbalance here. What are you expecting? You don't expect that low to be taken out because the what? Rejection block has already shown you that your SMT divergence, which I'm not showing here, but I'm telling you that's what would be the framework, the logic behind the scenes, the underpinnings of the marketplace. This low should not be traded beyond, and it should just start just going higher. So that high break in here, that's a market structure break. So when it trades back down into the order block, like this is an old low taking out what? Sell side liquidity. So while this is a 5-minute chart, and this was the hourly chart here as it passes down into the rejection block here, you have this old low here. So even if you weren't looking at this as a rejection block, because that's not what you want to use, you already know that below this low is what? Sell side liquidity. And comparing this low to that low with the dollar index or cable, if this is euro, and it's, again, it's not euro. I'm just suggesting to you that that's the, man, I tell you, this mouse. That low seen here on the 5-minute chart. So we have this low, it takes the sell side liquidity out. That's a turtle suit. And then you wait. Does it run back up and take out the high? That's it. That's all you got to do. You could be a buyer on that, yes. You can buy the sell side liquidity on the SMT. Or wait. Use it as, okay, now I know I have a setup forming. Wait until market structure breaks and then come back down and get the order block at the imbalance. Optimal trade entry here, there, boom. Now you can be a buyer and then look for all the down close candles to support price. And pyramid, if that's what you want to do. You might be intrigued with the pyramid examples, okay? Or you might be looking at this saying, okay, I see what he's saying about the rejection block, but I wouldn't look at that one. I can see this optimal trade entry here, and then I can understand everything that he said about that. And instead of doing a 10 standard lot down here, if I can get the mouse shut right down here, I'm going to do it on this optimal trade entry here. So I'm going to use a 10 lot there and go in 8 here, 4 here, and let it run. So I know some of you are thinking that, and that's good. That means you're learning and you're acquiring the experience to know that, well, while this isn't necessarily my cup of tea, using the rejection block and entering down here because that's scary, because I won't trust it. Okay, that's fine. The break in market structure, you all trust that. And you have the backdrop and underpinnings of the rejection block with SMT divergence. That would frame your underlying reason or the catalyst for looking to be long. Then you wait for entry patterns. This is the selection or catalyst to set you in a buyer's model or buy program. So when you're in a buy program, now you're just going to wait for your entry pattern. But you have to have a reason to be a buyer or a seller. And once you have that, once it's in the market and an order flow gets in sync with your narrative and your bias and where the draw on liquidity is, something up here, you know, whatever that would be, relative equal highs, an old high, old low, an imbalance of some kind, a bearish order block, a bearish breaker. There's many PD arrays that are premium, whatever that would be to frame that logic that you're reaching for. It's got to match your personal perspective and personality. And if you do that and you submit to that, you won't second guess your model. You